Hi everybody. Okay, this is lecture for topic 9. This topic is about equity. So remember, in the previous lectures, you have learned about accounting for asset, accounting for liabilities, and now you are looking at accounting for equity. So always remember, this course is accounting for companies. So always aware that a company is a business owned by the shareholders. So shareholders, they have shares in the company. So equity is the simple definition for equity is the amount owned by the owner of the business. So for a company, equity is related to amount owned by the shareholders in the business. Okay, let's see. It's it's a bit complex because shares is quite complicated to there are many process, the issuance of shares, the selling of shares, the process after the issuance of shares, etc. Okay, let's see. So here equity has to be seen or can be seen in two aspects. First, the equity for a company can be seen in terms of capital, and also can be seen in terms of reserves. So capital of a company is related to share. So you will learn a bit about shares in this topic. And then for reserves, there are three types of reserves: retained earnings, capital reserves, and revenue reserves. Okay, these are several terms that you have to know related to the topic of equity of a company. So first, the term equity. So before this, I have told you the simple definition for equity is the amount owned by the owner of the business. So now the definition from the accounting standard is like this: equity is the residual interest in the assets of the entity after deducting all its liabilities. So according to this definition, this equity is equal to equity is equal to assets minus liabilities. So this is referring to the accounting equation. If you remember the accounting equation, the equation is assets always equal to liabilities plus equity. So what is equity? Equity is equal to asset minus liabilities. So this is the definition used here. So capital. Okay, so what is the definition? Capital is funds contributed by owners of the company, normally called share capital for the companies. Okay. Reserves. Okay, what is reserve? Reserve is an equity account attributable to the owners of the entity other than the amount directly contributed by the owners. So sometimes there are something that is not related to capital contribution, but it is still an equity. So we call it reserves. So let's see. Reserve, there are three type of reserves that you should know. The first one is retained earnings. Retained earnings are profit or losses that are not distributed but maintained in the entity to finance operation. Capital reserve is reserve representing the capital maintenance, adjustment, or creation from shareholders' contribution. Okay, capital reserve is not something an increment in the equity of a business, but it is not from the amount contributed by the shareholders. So from from other sources. So revenue reserve is reserve that is derived from earnings and represents appropriation of earnings. Okay, the capital revenue reserve is reserve that is kept by a company to be distributed to the shareholders later in the form of dividends. Okay, so this one, okay, this is the equity in accounting equation. So this is like I said earlier. So if there is a question asks you what is an equity, so equity is equal to assets minus liabilities of a company. Okay, equity versus liability instruments. So equity is related to capital. Capital is related to shares. So when a company needs more capital, the company will issue shares to the public. Okay, if the public or people purchase the shares, then the company will get more capital. Okay, so here this table shows the difference between capital or shares and other sources of financing. So if a company if a company needs cash to do something, then the company has two choices to get the cash. First, the company can sell shares to get the cash, or second, the company can borrow. The company can borrow from bank, or the company can use borrowing instrument like bond or debentures. Okay, if you do not know what is bond or debentures, then you have to read some from other sources. Shares is a capital instrument. Bond or debentures are liability instrument. It's like borrowing. When a company is issuing shares, the company get capital. When a company sells bond, then the company is like borrow cash from somebody, from people. Okay, so let's see here. Ordinary shares. Okay, there are two types of shares. One is called ordinary share. The second type of share is called preference shares. Okay, preference share. And debenture or bond is a liability. If a company sell bonds, then the company sell the bond to the people or institution. It is like the company borrow money from the people or institution. Every year, the company has to pay interest to the bondholder. Let's say I have a company. My company need cash, so I sell $1 million bond. So many people purchase the bond. So the bond will be in the smaller amount, like several thousands. So many people purchase the total bond I sold is 1 million. So the bond has a maturity date. Maybe the bond will mature in 5 years. So every year, the company has to pay interest in the bond. The bond has to have interest attached to it, maybe 5% per year, 7% per year. So every year the company has to pay the interest. At the end of year 5, when the bond mature, the company has to pay back the principal plus the interest related to that year 5. So it is like a liability. But if a company sell shares or issue shares, then the company sell the shares to the external parties, And the external, if the external parties purchase the shares, the company get the cash and can use the cash to finance its operation. But the company has no obligation to pay interest or dividend or etc. Because when a person purchase the shares, it is like the person own the is the owner of the business. The person, the shareholder, take risk to have the share, and they can expect capital appreciation and dividend. So that is the difference. So you have to, if you do not know about shares and the bond, and then you have to read. Okay, preference share is somewhere between share and the bond, the bond or the liability. So if a company sell preference share, the preference share holder has to be paid interest every year. It has fixed rate. But if anything happen to the company has no necessary to pay back the amount invested by the preference shareholder. Okay, let's see the differences between these three categories of instrument. Okay, let's say there is a company, and then the company sell ordinary shares to the public, and then also the company sell preference shares to the public, and also the company sell bond or debenture to the public. So the people, so see the first point, the people who own the ordinary share will have voting right. The people who own the ordinary share can attend the annual general meeting of the company and can vote in the meeting. But the people who own the preference share do not have the voting right. The bondholder also do not have the voting right. So because bondholder is like a creditor, so they don't have voting right. A preference shareholder is almost like a creditor, because the company has to pay interest every year to the preference shareholder, so they have no voting right. But ordinary shareholder is the shareholder, the owner of the business. They have voting right in the AGM and in the meeting, in the company's meeting. Okay, rate of return. So the ordinary shareholder, there is no fixed rate of return. The company do not promise any dividend every year. But if many companies, they pay dividend, but they do not promise 5% or 3%, 20 cent or 30 cent or 50 cent. No. So the return is not fixed. But for preference shareholder, the return for them is fixed. Every year, the company has to pay certain percentage of it's like more like interest. The debenture and bondholder will get the fixed return also. Okay, so and then how to record the return for the ordinary shareholder. So for ordinary shareholder, when a company pay dividend to the ordinary shareholder, you have to record it as a distribution of profit. So you have to deduct the equity. You have to use the revenue reserve. When the company pay the dividend, the related account is the revenue reserve. And then when the company pay the preference shareholder, the company also has to deduct the profit of the company. But when the company pay the bondholders, interest to the bondholders, the company has to record it as an expense, because bondholders are like creditors. Bond is a liability. Reimbursement status. So in case of the company collapse or bankrupt, what should the company do? So if a company bankrupt, the company has to dispose all the assets, and the company has to pay the bondholder first, because the bondholders are the creditors. So the company has to pay liability first. After, if the company has paid all the bondholders, then the company should pay the preference shareholder. Okay, so the preference shareholder is in the middle between the liability and the capital. And then after that, if the company has paid to the all preference shareholders, if the company has still have assets, then the company should pay the ordinary shareholders. Okay, so that these are the difference. So you have to understand the difference between ordinary share, preference share, and the debenture. Okay, this is accounting for issue of share capital. So accounting for the issuance of share capital. This is the way to record this is the way to record when a company sells shares to external parties. If you have a company and then at one time you need capital, you need cash to do something, to do operation or a project, then you can sell shares to get the cash from external parties. So this is how you should record the issuance of shares or the selling of shares. So first you have to know these terms. Issued capital. Issued capital means share capital that has been successfully issued to shareholders or sold to the shareholders, regardless of payment received or payment received from shareholders. Paid up capital is issued capital which has been paid by successful applicants. This capital includes capital paid in advance, although it is not yet called for payment. Okay, so now issued capital means the share capital that has been successfully sold to shareholders. So in Malaysia, in other countries, in some countries in overseas, sometimes they sell share first and they allow the people to pay later. So when they have something like that, they have the issued capital. But in Malaysia, most of the time, when a company sells shares, they ask people to pay straight away. They cannot pay later. So in Malaysia, if you want to purchase shares, you have to have cash. You cannot do payment in stages. So I think the relevant term that you have to know in Malaysia is paid up capital. When you check the financial statement, when you see the term paid up capital, it means that all the shares that has been sold to the public and the company already got the cash from the public. Paid up capital. Shares that have been sold by a company to the outside parties and the company already got the cash from the sales of the shares. Okay. So call in advance, call in arrears, call up capital, uncalled capital. These are all terms related to selling of shares, but the shareholders or share buyer will pay in stages. So this is not a common practice in Malaysia. In Malaysia, when a company sell shares, they most of the time they will ask the share buyer to pay in cash. Okay, so don't have to worry about that. But you have to see the last one, par value shares. Okay, par value shares are shares that have original or nominal value. Several years ago, before 2016, we have par value shares in Malaysia. A company has to record the par value shares, and then some companies, they sell their shares in premium. They sell their shares at the price more higher than the par value, and some businesses, they sell their shares at discount. They sell their shares at a price lower than the par value. So after 2016, we don't have this kind of thing anymore. Every now the company in Malaysia, you don't have premium or discount shares. Everything is shares are sold at certain price, and all the amount collected from the selling of shares will be credited to the capital account. Okay, now in Malaysia, we have no par value shares. A company can set any price. A company can set a price for their shares, and then they can sell the shares to the public, and all the amounts can be credited to the capital account. Okay, see here. Okay, see here, par value shares. So like I said earlier, before 2016, company can sell their shares at premium, at par, or at discount. Now, all the practice is no par value shares. In Malaysia, a company can set a price for its shares, and the company can sell it to the public. We don't have to record it at premium or at discount or at par anymore. All the amount got from the selling of shares should be credited to the capital account. So don't have to worry about that terms anymore. Payment in full on application or payment in stages. Okay, like I said earlier, in Malaysia, the common practice is when a company sells shares to the public or to the external parties, they always ask for payment in full or payment in cash. In other countries, in some countries they sell shares and they ask the share buyer to pay in stages, but not in our country, as far as I know. So oversubscription or undersubscription of shares. Okay, the situation is like this. When a company want to issue or sell shares, they have to apply to the Securities Commission or something, and then they have a specific target for the sale of shares. For example, a company want to have capital of $10 million. So they will sell shares to achieve that $10 million. Okay. Sometimes when a company, if the company is a good company, when the company want to sell $10 million of shares, the company will have oversubscription. Oversubscription means people who apply to purchase the shares. There are many people apply to purchase the shares. The total application is more than the amount that the company want to sell. For example, the company want to sell shares up to $10 million only, but the people who want to purchase the shares, the application is like 15 million or 12 million. So that situation is called oversubscription. But sometimes the situation can be an undersubscription. Undersubscription is like this: the company targets to have $10 million cash to do something for the business. When the company sell shares, their target is 10 million, but when the company sell shares, not many people like the company. So let's say the company got only 8 million application. The total application dollar is 8 million only. So the situation is called under subscription. The company want to sell $10 million of shares, but the willing buyer is only $8 million. So 2 million under subscription. So most of the time, if there is an under subscription, the company will have a party to do that we call as underwriters. Underwriters is the party that promise to purchase the under subscription shares. Most of the time, the underwriter will purchase the under subscription shares at discount. Like I said earlier, let's say a company want to sell $10 million of shares, but the share buyer only willing up to 8 million only, to $2 million under subscription. The underwriter will purchase the 2 million under subscription, but will pay a discount. Okay, and then another thing that you have to know is cost of share issuance. When a company want to sell shares, there are costs that they have to pay to the parties that manage the issuance or the selling of shares. Forfeiture of shares is related to shareholder fail to settle payment. Forfeiture of shares is something like this. Applicants, they said, some people, they apply to purchase their shares. When the application is approved, they cannot make the payment. So the shares that is unpaid by the share buyer, we call it forfeiture of shares. You like cancel the application. When shares are forfeited, the company has to reissue or to sell the shares again. So that process is called reissue of forfeited shares. Okay, the way to record the issuance of shares, you have to look at the example 6.1, issuance of no-par shares in the textbook, and also example 6.2, issuance of no-par shares. This is the number is I refer the number to the first edition book. The book that you have now, you check the book that you have now. The book that you have now is second edition. So you check in the book, an example of accounting record for issuance of no-par shares, and also example for the issuance of no-par shares over subscription of shares. Okay, there are many examples. Focus on these two type of accounting record. How to record these two type of situation. Okay, thank you very much. This is the end of the first lecture for this topic.